All right, good morning, everybody. Doc Severson with you here at Trade School for ReadySetCrypto. Today is Friday, the 1st of May. Welcome aboard for those of you that are on board with us here live. If you're not live, if you're watching this through a replay or some other type of archive, you trolled through the archives and you stumbled upon this, welcome aboard, and glad you're here with us. Regardless, you can always send us questions about today's session. I would expect to see a number of questions down the road from today's session because what I'm talking about is a little bit more advanced, which is that of time spreads today. So let's get into this. I'll be down in the corner. If I get in the way of anything, please let me know. Let me know and I'll get myself out of here. So today, we're not going to be talking about any specific trades, but we are going to be talking about time spreads, part 2. Now, I talked about time spreads, part 1, back on the previous session, which was on April 17th. Time spreads, part 1, which was what is a time spread and what do we do with them? So just a reminder, what a time spread is that we're going to see, let's get the magic pen going here. We're going to see something like this, like an option with a short time period left to go. We'll call this TF, T sub F, for front time. And that option is going to start out with a certain amount of time value, but then as it gets closer and closer to expiration, it will dive in value like that. Probably didn't draw it with enough of an exponential sense to it, but you get the point. And then we have what's called a time back. So T sub B. T sub B. And that's going to start with a certain amount of time value, and that's going to keep most of that time value until it gets closer and closer to that specific expiration date. And what we're talking about here is trading one versus the other. And if we go on this date, the front expiration date, then this back option is not going to lose that much time value, but this front option will lose a lot of time value. And so what we're going to do is use the spread and really trade the differential of the two against each other. And you'll see how that works in a second. What we want to do is we want to sell that shorter term option. Anytime we want something to decay, we want to be selling an option. Anytime we don't want something to decay, we want to be buying an option. That's that longer term option, which is the hedge option in this case. The shorter term option, or what I call the front option, because it's going to have a very short term, it's the front versus the back. It will lose value dramatically with a small amount of remaining time that it has left to live. And the longer term option will still lose value, but very slowly, as we saw in that diagram. We want to capture the differential between the two. So what this means is, this is the red line here is the profit and loss into expiration of what's called a calendar spread. This is a form of time spread that we're going to play. The green line represents the T plus 0 line. So that is the profit and loss just today. So if the price were to move around down or up, you can kind of map this against the analyzer. This is the Deribit position analyzer. And you can see how this would go. So yeah, there is, if the price goes dramatically up or dramatically down after we enter the trade, that's not what we want from this calendar spread. So you can kind of get the idea that this is the type of trade where you want the price to stay pretty much in one spot. So you should be starting to think about applications where we could identify that. Now, if we go forward 5 days, this is what this trade's going to look like. The real-time profit and loss is going to jump up dramatically because that's a differential between the long holding its value and the short option that we sold dropping down in value, which means that we could buy it back cheaper. And so if that doesn't make sense, you might want to experiment a little bit with these. But it will jump up in profitability, assuming that the price stays within this range of the calendar spread. That's the key towards success with this trade, Is the price staying within this price range? Okay, everybody good so far? So let's talk about offense first. We'll talk about setting up the trade, what we need to do to set up the trade, how we kind of dial this thing in, and then we'll flip around and play defense with the trade. How to adjust it, how to get out of it, those kind of things. Time spread offense. I'm only going to talk about one variant of the time spread. There are many, many, many different ways, not only to trade options, but also to trade time spreads. You may not have heard about a time spread, but a time spread really means that you're trading one option versus the other in terms of time. And it's really the passage of time, which is the edge in the trade. The differential of how a short option erodes versus how a long option erodes. So we're going to be placing these as the at the money calendar spread. So when I talk about at the money calendar spread, this is the current price right there. You can see this vertical line that represents today's current price. Now, I could be trading these as out of the money. The price could be here, and maybe I've got a target that's up here that if the price goes up to here, it will hit that target and make it profitable. That's one way to trade them. We could certainly do it that way if we wanted to. That's not, however, the application that I'm outlining today. Okay, we can place these at the money. We can place the short and long options at different strikes. That would be a diagonal spread. Not going to do that today. The at the money calendar spread has you got one job. Allow the front short option to expire as quickly as possible. And the best way that that's going to happen is if the price doesn't move. The price doesn't move at all. So the application for this trade is a flat, trendless market with low implied volatility. When do we get something like that? Do we get a flat, trendless market if the price is doing this? Like bear flags and then breaking lower and bear flags and breaking lower? No, not really. I mean, it's possible that we could win in something like this, but a better application would be when markets are in quiet and trending. They're consolidating, they break out, they consolidate, break out, consolidate. This is what I call stair-stepping price action. So we see this when we get into these sort of like slow grinding moves to the upside. Breakout, consolidation. So once the breakout happens, everybody chases after it and it ends up being a very flat market for several days. Aha. That's exactly when we want to be using something like this. Let's go over the entry conditions for a minute. So today's session will be fairly short. I'm just going to go through how to enter, how to adjust, how to exit, those kind of things, and show you an example. And I'm going to show you a tool, a worksheet that I will upload onto the archive page for the trade schools. It's an Excel spreadsheet. You're welcome to hack it up if you want. Okay, so expected forward price movement is range contraction. So we want to be entering, not range expansion, but we want to be entering when we expect this to go into range contraction like this. So a hint for you might want to wait for an exhaustion condition on the chart that you're using. It's best during quiet and trending uptrends. Usually best to enter at the top of a breakout flagpole. So remember when I was talking about the stair-stepping conditions, like this, and then breakout, and maybe we'll get a day or two of breakout, and then it'll go quiet for a number of days, just digesting the gains, and then we'll break out again. So when I say flagpole, what I'm talking about is the top of the flagpole here. Also precisely when it feels least likely to continue or to stall out there. Usually what people feel is like, whoa, this thing is going to trend forever, isn't it? Kind of like what we saw a couple of days ago. It's going to trend forever. It's going to go up to 80,000 by tomorrow. No, it's not. It's going to consolidate. So sometimes you have to get used to this. And I think the biggest mistake that I see people make is like they see a flagpole like this and then they see several days of consolidation and then they go, oh, okay, so this is a flat market. Now I'm going to place the calendar spread. They place the calendar spread and then boom, they get run over because they're too late. You have to place these when you're anticipating contraction, not when you've confirmed it. Front option, I would sell somewhere between 2 to 3 weeks of time. Hopefully you don't need to sit in the trade the entire time through that. Okay, but you want to sell about 2 to 3 weeks of time. You can use both puts or both calls. Typically, I will start out the offense with a put calendar, and I'll show you why I do that. Back option. So if we're selling 2 to 3 weeks of time, you want to get an additional 3 to 4 weeks of time beyond that front option. This is not cast in stone, but you need to have a differential in time. You can end up paying, you can certainly buy an option that's got a lot of time to it for your back option. The disadvantage there is it's going to be expensive. So it should be fairly stable. But the other disadvantage is if you buy too much time, it's going to be that much more sensitive to slight changes in applied volatility. Now you must ensure that the IV differential from front to back is not too high. What on earth are you talking about, Doc? All right, let's get into that. If you go to the option chain, what you'll see is you'll see a couple of different volatility figures. I'm just going to pick on one here. But if I look at the front May puts, and this was this morning for 9,000 because the price was around 9,000. We were looking here at the implied volatility of the offer side being about 78.4%. Okay, that's all right. And then I looked at for this particular trade, this example, I looked at 29 May, which is obviously 4 weeks out, and this is showing 79%. So the differential is between front and back. And you can see the differential here is less than 1%, which is really good. Now the differential between these two is a little bit different, but really, you just pick one of them. That's fine. Just pick one of them and that's going to be okay. If you want to be precise about this, you're using this one here because you're buying this and you're selling this one here. But still, if you're within a few percent, that's okay. But I'm comparing apples and apples here on these, and that's all right. Do not buy a whole lot more back volatility than front volatility. You'll put yourself in kind of a bad position. You won't get very much room to work with, and this is going to make the trade hard to work. It's common to have more back volatility than front volatility. So it's very common to see your back trade have a higher value than the front trade. That's very common because it's got more time to do something with that. So that totally makes sense. That totally makes sense. But, and if I'm in the way, let me know and I can get rid of my little face down in the corner. So this example shows that the volatility are within 1%, which is fine. So let's talk about defense now. So again, you're going to look for a period where you're seeing exhaustion, you're anticipating movement into contraction, and then you're going to place a front option short, which is going to be, perhaps a week or two out. And then you're going to add 3 to 4 weeks on top of that for the back option. Generally using puts to begin with. Short the front put, long the back put. Let's talk about defense. The first thing that I do when I'm trading these on equities is put in a complex order for the entire spread to get out with a 10% gain. Right off the bat. That is my ideal exit. We get 10%, and sometimes these will fire within like 3 days. I've seen 2 days. I've seen 3 days very often. If we get that really nice, just sort of slows down and just goes sideways, 2 to 3 days, 10%, that's a nice return. And it's relatively easy to do that. So I don't know of a way to do this with the crypto brokers like LedgerX and Deribit. They're just not, the last time I looked at Deribit, they did not handle the complex orders of placing both of them at the same time for a debit. No, they could have changed, but they don't want U.S. customers, so I don't know. And certainly LedgerX doesn't do that right now. What I will say is that everybody will do this at some point. If crypto options are going to become a thing, then they will handle complex orders, both entry and exit. So get used to that. And yes, you can also use this technique in the equity markets. You can do this on anything that you want to, even futures options. So for now, you have to monitor the differential. You have to look at the profit of the short versus the loss of the long. And when it gets up to differential of 10%, then out you go. So the most I want to lose on a trade like this is 15%. And quite honestly, the way that I'm showing you here, it's, I can't remember a time that I've ever lost 15%. This is usually on a case where like you get an overnight move that you just have no chance to adjust this thing and you just got to get out. You just stepped in front of the freight train and you've got to get off the tracks. So I'll try to keep that to 15%, but honestly, I can't remember the last time I had to do something like this. So odd things will happen. So this is one thing that you're not used to. If you've ever traded vertical spreads, you get this rock solid profit and loss graph and you don't have to deal with this stuff. But what happens is if you're a short option, if the implied volatility stays fairly steady or maybe even goes up a little bit, and then your long option implied volatility goes down. When would something like this happen? This may actually happen if you have something like, so this is 8 days and this is maybe 30 days or something like that, right? And this is the market anticipating, well, we're probably going to get a big event coming along in the next couple of days, but after that, everything's going to settle down. So the market's already starting to anticipate that in 30 days, everything is going to be just okie dokie again. No problem. And so you can run into weird things like this. Notice how the area under here, the profitable area, is very tiny. It's like, oh man, I got no room to work with on this trade. And if you're still at break even, I would just get out of this because there's almost no way you can profit from a trade like this. You've only got downside in either direction at this point, and so your edge is gone. So you can see weird things with the implied volatility. Time spreads will make you a better trader because it forces you to look at things from many different angles and anticipate what's happening, not only with the price, with the time, and also the volatility. You'll become a much better trader if you focus on time spreads. So this is why we try to really pre-qualify these trades ahead of time. There's one very specific type of price and volatility. There's one application for this trade. One application only, and it's for right after a breakout and the price fades into a consolidation. That's the only time that this is worth anything at all. So what do we do if the price starts to trend again? So let's say we get into something, we attach the breakout, and then it maybe consolidates for a couple of days and then starts to go again. And we're like, wait a minute, what are you doing? Don't forget the price can do whatever it wants to do. Just because we think that it should consolidate, we're putting our values and our hopes and dreams into a trade based on what we think should happen, and maybe based on what it's done in the past, and maybe based on the value of a certain study. But never forget the price can do whatever it wants to do. If there's a supply demand imbalance, we will see the price continue to trend. This is where we consider the double calendar adjustment. So once the price gets within 15% of the break-even point, remember the break-even point was when we had that kind of, this is the expiration graph, and here's the break-even points. And if it gets within 15% of that, of the width of the spread, the width of the calendar spread profitability, if it gets within 15% of the break-even point, this is where we pull the trigger on an adjustment. So this is if the price had rallied up to maybe this point or so. Then what we do is we turn it into a double calendar. I couldn't change the price, so the price, you're presuming that the price would be up to here within 15% of that original sort of TP, if you will, almost the triangle thing. And this is where we add another one, and the combination of the two turns it into a little bit of a circus tent. And we have much more room now for the price to wander around inside for the double calendar. So you may think, hey, well, that's great. Maybe I'll just do double calendars all the time now because it gives it more room for the price to run. And there's a higher profit potential because now you're trading two positions, higher profit potential. The downside here is that it's going to take much, much longer for you to get the profits. It's going to take longer for those options to decay because now they're out of the money. The very fastest that you're going to see time value decay on those front options is when they're right where the price is, right at the money. That's when the fastest time decay happens. So in this case, this is a 9,000 and a 10,000 put calendar and then call calendar. So I'll start off with a put calendar. If the price rallies to the upside, I'll put a call calendar. The reason why I do that is the short options are then out of the money. Now, it doesn't matter on a deribit or somebody with a European settled options, cash settled options, but it's good practice to get into if you ever trade something like American settled options, which is what equities use, that if you have a short option in the money, you can be assigned early. And that's no fun. No fun at all. So what I'd like to show you now is a tracking spreadsheet they use for calendar spread that allows you to calculate the action points based on analyzer values. Okay, and that is right here. The sheet is right here. So what I'd like to do is I'm going to start to fill in the sheet with a trade that I would take right now if I were to take it. And so we'll set the lower and upper break-evens. And so this becomes kind of a tracking thing for you. You can add a new tab every time you do one of these trades. So let's go through and let's look at the option chain and see what we would set up for a trade right now. Okay. So if we're looking through something like this, like in Deribit, and again, there's no perfect ones here because it's like I could do 29 May or the back option could be as late as 26 June. Let's do just the 8 May. And if we do 8 May, right now the price of Bitcoin is 8,800. Now I could pick the 8750, but I know that that would be closest to the money, but I know that the 29 May doesn't have those options. So I'm going to be forced to use 9,000. You want to use the same strike on both of these, the same strike price. So 8 May, and I'm just going to write these down. 8 May is on the put side. Let's call this, and the analyzer is going to help us figure this out. But just for the purpose of putting these things in to my analyzer doesn't work off of BTC values. So we're going to say that the 9,000 put on 8 May is going to be, let's call this $430. Okay. And the current price is 88.29. All right. And then let's go out to the 29 May. And 9,000 put is going to be about, if we buy this, let's say it's $840. So we have to buy this one at $840 minus the credit that we pull in at $430. So the differential for these two is going to be, for one full Bitcoin, it's going to be about $410. Does that make sense? So let's pull out our analyzer. And I'm going to bring this guy over here. So again, what we're going to just do is we're going to pick on the 8 May, and we're going to go to the 9,000 put, size 1, just for the analyzer. And this is going to be a short option. So that's a short 8 May. Oh, I'm sorry, I put 3 May. 8 May, there we go. So I'm going to have to kill this one. 8 May, 9,000 put, size 1, short. Okay, there we go. That is correct. Now let's go to 29 May, 9,000 put, long option. So you can see we've not exactly centered this. We've not exactly centered this. So now what we can do, let's mark down our break-even points. The break-even point is 84.23 to the downside, and the break-even point up here is about 95.71. Those are the break-even points. Okay, so now what I'm going to do is go over to the spreadsheet and start filling things in. So I'm just going to say 8 May / 20,000 P. So we could look at the front and back month volatilities if we want. Let's go ahead and do that. Let's write those down. I think it's worthwhile to do that. Okay, so let's see. 9,000. If you look at the, so this is about 70.5. And if we look at the back month, this is going to be about 78.7. I think that's close enough. So the initial debit, let's just call this 410. One contract. So let's just say that there's a $1 commission. So $412. So our stop risk, let's see. That doesn't seem to work. Stop credit. Oh, I see. So $61. All right, that's what it is. So the lower break-even point is 84.23. So the yellow fields here are the ones that I can place in. 95.71. 1000 call. And position 2 debit is going to be also, let's just say, 430. So the total position debit is going to be like $840. Total net debit, $844, right? Okay, so now we want to go for an 8% profit target because we have a much bigger position. And our stop, our entire stop, is about 12%. Our lower adjustment point now is going to be either 1,000 or 10,000. It's going to be the short strikes, or it's going to be the strike price of each side. Now, what does that look like? Let's go back to our analyzer. If we can find it here, somewhere in there. There it is. So if, again, we're assuming that the price is up to 9,400 at this point. So that's why we're making the adjustment. I can't move this line. So if the price goes down to here, then we have to adjust it again. Or if the price goes up to here, then we have to adjust it again. See, what you're doing is you're coming up with a mechanical way to move the trade around and eventually catch it with its pants down, consolidating, and then we'll win the trade. Quite honestly, this is the only adjustment I've ever had to make, is to a single, to a double calendar, and then that's usually enough to allow me to win the trade, shut it down, do whatever I want to with it. But there's actually a third, and that's if the price gets to the next adjustment points. What we do, so let's assume that we have a rally up to 10,000 BTC, and we're still in this trade. If I can take it off for a profit at that point, I should do so, because if we get to that point, then maybe what's going to happen is enough time has gone past that the price is now up to my adjustment point, but it's showing a profit. So why on earth would I do anything else to this trade? I wouldn't. I would take it off for a profit and say, thank you very much. But there is a third adjustment point if you need it. And let's go back to the spreadsheet. The third adjustment point is simply, see the lower adjustment point and upper adjustment point. If the price were to hit, say, like 10,000, then what we do is we take off the old or the opposite one that's not being attacked, and we double up on the new one. So in this case, we would double up on this one. I've never had to do this. And then we're back to a single calendar. I've never had to do this. And I think a lot of this comes down to entering these at the right time. Trying to stay with a single calendar. This is going to be your fastest profits if you stay with a single calendar. I will only adjust it to a double if it hits my limits, and if I'm convinced that the price is going to keep on going, I will pull it into a double. But I've never had to go to the third step, which is to adjust it back to a single calendar. Okay, does that make sense? This is really what I wanted to go over today, guys. And I'm sure there's going to be more questions on this. And it may not make sense the first time that you go through this. But I will post the calendar sheet up here exactly as it looks right now. We'll just post it up to there so you guys can download it and play with it. And you can also use this on any instrument that you want to trade, whether it's the equity markets or whether it's cryptocurrency, anything. Anything that has options written on it, you can use this sheet. So I've been using this technique since, 2014? And it's actually been a very nice, easy trade to make because it's very mechanical. The only thing that I don't like about it is it's got to be very specific market character that you use. It's got to be that sort of stair-stepping character that you have. So let's while we have this here, let's just go out to the chart. Let's pull the chart up here. So this is kind of an example of when we'd want to use a move like this. Like when we have a big explosion, this is when we want to use it, because more than likely we're going to see the price crawl around this area for a few days, and that may be a good time to do it. But notice what you have here. Look at these rallies where you have consolidation, breakout, consolidation, breakout, consolidation, breakout, consolidation. And then eventually it starts. When you start doing this kind of stuff, you want to avoid it. This is really for uptrends only. You want low volatility environments for this. Now, can we do it here too? Breakout, consolidation. It's a little bit sloppier, but we may get a nice move here for that. But this is something else that you guys can do. This is another weapon that you can use. It's called the time spread. Specifically the calendar spread, because it is the edge that you have is undeniable. That front option will always erode faster than the back option. It will always do so. So that's it's Newtonian, right? It's going to happen every single time. It's going to happen every single time. Your goal, though, is to keep the price within a specific range. And if you can't do that, then you have to adjust it. You have to move the trade around so that you can capture it within the next range and maybe even expand the range just a bit more. Any questions? Anything else for anybody that's live with me online? Any questions? Anything else? If not, if you're watching this through a replay, let me know if there's something that didn't make sense or that I can explain better. But again, what I would do is if this is a very new concept to you, I just kind of like watch this video again. You can turn up the speed so you don't have to spend 40 minutes watching it again. Turn up the speed and you can watch it in 20 minutes. Just go through and see what I did and it'll start to make more sense. Especially if you use the trade spreadsheet. Okay? Well, thanks everybody. This is today's trade school for today, May 1st, 2020. And that is part 2 of the time spread, the calendar spread, very versatile income trade for trading options on any asset. Thanks everybody. Have a great weekend. We'll see you soon.